Hello, everybody, and welcome to the FCC Food and Beverage Report mid-year update. I am Darlene McBain, and I work on the Industry and Stakeholder Relations team here at FCC, and I'm happy to be your host for today's event. Thank you to all of you that are joining both virtually and in person. You are all an important part of Canada's food and beverage industry, so we thank you for finding time in your day to join us here. I'm coming to you today from my home office in Montreal, Quebec, and I do want to acknowledge that Montreal is the traditional and unceded territory of the Mohawk and Algonquin people. It is a place that has long served as a site of meeting and exchange amongst nations. And wherever we find ourselves today in Canada, we are on traditional Indigenous territories with rich traditions, stories, and histories that should be understood and honored. And it is our commitment in the spirit of reconciliation and collaboration to honor these people as vital contributors to our society and respect the diversity and strength of all of the Indigenous people across this country. Now, before I introduce to you our keynote speaker, there is a little housekeeping that I need to cover. This session will be recorded and a link will be sent out to everyone who is registered here today. So if you need to step away from the presentation, or if you want to re-listen or share this content with your business partners or colleagues, the presentation will be available to you in a few days. If you run into any technical issues, please feel free to press the support button for assistance. And as you may have noticed, there is a chat on the right-hand side of your screen. So you may drop in there any questions that you may have for JP, as there will be a Q&A session at the end of this presentation. Now let me introduce our speaker. We are thrilled to have JP Gervais with us today. JP is the Vice President and Chief Economic Officer at FCC, and his insights help guide strategy and monitor risks throughout FCC. And today, JP will be sharing with us the results of the mid-year Food and Beverage Report that was released just recently in September. This mid-year report examines the changes and trends since FCC published its 2022 food report in April and its 2022 beverage report this past June. Today, JP is here to provide some analysis of the report and other key trends that we're keeping our eye on, such as labor concerns, exchange rates, and domestic food consumption. Now, just before I hand over the mic to JP, I do want to mention that JP is joining us from a new FCC office in Ajax, Ontario. And today is the official grand opening of this office. So we do have guests that are present with JP in the room, and of course, a number of you joining us virtually. So again, welcome to all of our guests, and welcome JP, and I now will hand it over to you.
Well, thanks so much, Darlene. Let me adjust the screen here. So thanks so much. Good morning, depending on where you are in the country, or good afternoon. I am, as Darlene was mentioning, joining all of you from the Ajax office at FCC. Just opened an office in sort of the GTA area, and yeah, doing this in a hybrid format, which is exciting and brand new for all of us. But I think the technology is going to work just fine. So if you wonder about the little bit of a design behind me, this is a map of the area, and actually we're located right just above my left shoulder here. So this is really live, and really hopefully if you're also watching this recording afterwards, thanks for joining us as well. If you want to bring up the PowerPoint deck, I would just need to, basically the point today is to share with you a little bit of information on our food report, provide a mid-year update. So 6 months after we published, as Darlene said, our food report in late or early April, and really look at some of the trends that we are monitoring in the marketplace, in the operating environment, and as well as provide a little bit of the forecast that we use as well internally at FCC. Now, I think it's fair to say that the main story in 2022, right at the beginning of the year, was inflation, right? Right at the top of the year, food inflation was around 6%. Overall inflation was not too far behind. And if you look at where inflation is right now, I mean, some commentators could actually be seek or find a little bit of reassurance in the fact that we've had 2 consecutive months of overall inflation in Canada coming down, right? So we had 2, not much of a trend, but nonetheless 2 consecutive months. But I think one thing is clear, though, that's that downward trend in overall inflation was almost entirely, certainly in the month of July and to some extent August as well, almost entirely driven by lower gasoline prices, right? And I always like to refer to the fact that if we were to make the assumption that prices would stay where they are today till the end of the year, we would still measure inflation at the end of the year at around 6%. So I don't think that inflation is going to go away quickly, and we're going to be stuck with inflation for some time. And even if you think that we're finally breaking this pattern of high inflation overall in the economy, and if you look at food inflation at the retail level, and we'll speak to some of pricing trends as well at the food manufacturing level, but if you look at food retail prices, they're still going up. They're right around 10%, a little less if you're looking at food purchased in restaurants, a little higher than 10% actually if you only look at food purchased at grocery stores. So food inflation still going up, and that's a definite trend that we need to be thinking about when it comes to profitability forecast for the rest of 2022 and early 2023. Just before I move on to some of those forecasts, just looking at this particular slide here, and then we'll just blow it up. Yes, thanks so much for everybody to see it a little bit better. I highlighted a couple of numbers that I think are important, right? If you look at sales, when we measure it in dollars, so that captures the overall inflationary pattern that I was talking about, as well as the increase in the volume of sold by food manufacturers or food and beverage manufacturers. We're looking at growth in the first 6 months of 2022 measured against the first 6 months of 2021 of 13.2%, right? So that's pretty significant, but some of that growth definitely comes from inflation, and we'll say more in just a second. If we're looking at where is growth coming from at the retail level, because that does influence as well where growth's coming from at the food manufacturing level, well, clearly, I think at the food and beverage stores, we're looking at a flat market for the first 6 months of the year. And you'll see in a second that we're looking at July, August, and part of September, that this market is actually showing a bit of weakness now, a little bit more weakness than the flat trend that I'm showing up at minus 0.3%. But really clearly as well, we're not done with the rebound from the pandemic, right? When we measure what has been happening in the first 6 months of 2022, we measure it against the first 6 months of 2021. And clearly at the time, we were facing still at the time some pretty significant restrictions and lockdowns in some parts of the country. And you can see that some of the rebound in food sales has been coming from the food service sector as opposed to the grocery level. On the next slide, we're really looking at some of the source of growth in sales that I was talking about when we're looking at the price index for food manufacturers. Remember, we were talking about food inflation being around 10%. Well, at the food manufacturing level, again, if you look at the first 6 months of 2022 relative to the first 6 months of 2021, we had 9.9% growth in the price index. So with 13% growth in sales, I'm going to run it up to 10% growth in the price index. That leaves about 3% growth in the volume of sales for food from food manufacturers. You can also see that the beverage manufacturing price index has gone up at 4.7%. And that, I think, sort of hints at some of the challenges when it comes to profitability. And we'll talk about that in a little while here in terms of profit margins and some of the pressures that processors are faced with or are facing right now in the marketplace. One of the things as well that is worth noticing is some of the employment trends at the bottom of the screen. We'll talk about labor trends overall in the economy, but if you're just focusing on food manufacturing and beverage manufacturing, you're looking at some pretty significant increases in wages and salaries paid out to employees, right? 11.5% year over year for the first 6 months of 2022, 13.4% for beverage. So really, I do think that speaks to one, I would argue, arguably the number one challenge in the industry right now, which is a really tight labor market. In the we talk a lot about inflation, and a lot of the inflation actually could be quoted as or labeled as imported, in a sense that it still functions as supply chain challenges, functions as those supply challenges, so supply chains, globally that are not necessarily functioning all the way back to where they were at prior to the pandemic, for sure. But there's also some inflation that is purely domestic, right? Some of what you're seeing up here is the impact of savings. And you can clearly see that at the height or the beginning of the pandemic, I should say, we had a huge difference between disposable income that has been going up, the government's programs to support income and so forth, and consumption being down, right? The difference between the green line and the blue line would be savings, and you see that those savings grew during the pandemic. And we're now at a point where those savings are slowly being depleted, right? By the end of 2022 or early 2023 at the latest, we're going to have savings that are almost entirely depleted, and we'll be back to a saving rate that is back to what it was prior to the pandemic, very small. And so some of the savings that we have in the marketplace and in the economic environment are still driving some of the inflation, and certainly driving some of the inflation that we're seeing as well in food services. Now, Canadians have adjusted their food spending patterns. And so in this chart, what I want to highlight is the black bar, which shows the increase in the share of spending of consumers when it comes to food and beverage. That increase in spending has been positive, but it's been very small, right? Not even a 0.5% change in terms of the overall share of income that is spent on food. And so that brings an interesting question really, because we often say that we are in an industry that's quite immune to economic fluctuations. People need to eat and so forth. That's true in some sense, but it's also true that consumers, when faced with some pressures on purchasing power and so forth, will make adjustments to their food purchasing patterns, right? And so what this speaks, right, when we have food inflation at the retail level that's quite elevated, and more so than the overall inflationary pattern, that you would have expected, I guess, if things had stayed the same when it comes to food purchasing patterns, you would have expected that particular graph to show a little bit more of an increase in food and beverage spent as a percent of income, so that basically suggests to me that consumers are making some assumptions. And these are just the Q2 numbers, and you'll see a little bit of evidence later on as well that this adjustment in purchasing patterns from consumers has actually been continuing to go. Actually, this is the slide that I was talking about, right? So remember I said that sales from food manufacturers were down about 3% overall. So this looks at not only January to June, but add on July, August, and part of September. And you can see that grocery volumes did indeed decline for food and beverages, more so than the somewhat flat trend that I was talking about early on. So again, more evidence that consumers are adjusting their purchasing patterns, are moving towards perhaps the lower value, lower quality type of meals when possible. And that's not always the case, but when possible, consumers are indeed making shifts towards lower value and lower quality, and faced with some pressures on their purchasing power. People made a great deal out of the fact that now we've had shifts in the consumption point for food by consumers. And indeed, obviously, when we had lockdowns, I mean, we had a major shift towards food purchased and consumed at home instead of away from home. But as we're seeing right now on the chart, we're pretty much back to normal. There's been a huge rebound, a significant rebound for the first 6 months of 22 relative to the first 6 months of 2021, especially when you focus at the beginning of the year. But we're pretty much back to where we were when it comes to the shifting or the patterns in terms of purchasing food for consumers. Now, I want to say a couple of words here on the labor market. Remember at the very beginning, I said wages have been going up in the first 6 months of 2022 at a rate around double digit, basically, right? Even around 13% for food manufacturers. When you look at wage growth, and that's the chart on the right-hand side of the screen, you have the year-over-year most recent data point in the overall economy. So this is not just for food manufacturers, but it's the overall economy. We have wages going up at a rate of 5.4% year over year. So quite clearly, in the food processing sector, labor pressures and labor challenges are a lot more significant than the other parts of the economy. On the left-hand side, and I'm not going to get through all the different labor indicators, but there's just a list of different indicators that speak to how much constrained and how tight the labor supply is relative to labor demand. And if you're interested, as I was going to say, if you're interested, we just published last week a study on long-term projections for labor. And what we're basically saying in this report is that if making some assumptions about future growth in food demand, which will be met with an increase in food production domestically here in Canada, making some assumptions with regards to labor needs based off this higher food demand, as well as accounting for the labor supply based off the natural rate of growth in population and the Canadian population, as well as immigration patterns and so forth. Best case scenario is we're probably going to be in the same situation as we're in 10 years from now. And that would be the best case scenario. So those labor issues are not going to go away, and then are going to be a big challenge for food manufacturers going forward. I did refer to our website, and a lot of the information that you see here up on in the presentation is available as well at the FCC website at fcc.ca/knowledge. On the next slide, what we have is some of the estimates, I believe, of, well, first of all, before talking about margins, I would like to say a few words about interest rates, right? Because I do think that's the number one question we get as a lender, question about interest rates, whether or not businesses should be locking in interest rates and so forth. So with high inflation, not a surprise, everybody's aware that the Bank of Canada has lifted its overnight rate by 300 basis points, so 3% between the beginning of the year and the last decision of the Bank of Canada not too long ago. Now, so going forward, if you look at what the markets expect from the Bank of Canada, right now we have another increase in the overnight rate of the Bank of Canada of 50 basis points that's priced in at the end of October at the next scheduled decision of the Bank of Canada. And the markets are split a little bit on whether or not there will be another 25 basis point increase in December. So you're looking at between 50 and 75 basis points more in the overnight rate of the Bank of Canada between now and the end of the year. And after the end of the year, it's basically wait and see. Now, if you're wondering about overall borrowing costs, I mean, the market's always forward looking. So it's not about what the bank has done, but it's also what the markets believe the Bank of Canada will do going forward. And as I said, right now they're pricing in another 50 to 75 basis point increase between now and the end of the year. So if you believe that this is done, then you should see right now borrowing costs that are not going to move up from where they are. If this is, in the eyes of the Bank of Canada, not necessarily enough to break the inflationary patterns and so forth, then maybe we should see a little bit more increases down the road in the overnight rate, and that perhaps is going to lift even more the Bank of Canada. We are working with the assumption of another 50 basis point increase in October and a 25 basis point increase in December. So we're working with that assumption of 75 basis point increase at FCC. Having said that, I mean, one of the questions I get all the time is, well, when can we expect rates to come down, right? So we've been through this cycle, this rapid cycle of increasing interest rates. So when can we expect the Bank of Canada to actually decrease or lower their overnight rate? I would have said a couple of months ago that, yeah, you're not going to have to wait too long. I mean, the economy is, it takes time for higher rates to make their way through the entire economy. It takes time for businesses, households, and so forth to renew loans at a higher rate and really feel the financial pain of higher rates and so forth. That's still true, but in a sense, I do think that the bank has sent a pretty strong signal last time that they're expecting to keep rates where they are for some time. And so that some time is debatable, but I do think that we're not going to see the Bank of Canada lower its overnight rate until towards the end, so Q4 of 2023. Until, maybe a couple of months ago, I would have said perhaps expect that, there'll be some moves made, in the mid-year 2023. But now I think it seems to me that the bank wants to make sure that it kills inflation. And that's the number one priority. And even if we have an economic slowdown in Canada, whether or not it's a recession, I don't think it matters. It's just a technical definition. I think we'll have at some point a slowdown in the economy. Consumer spending is going to slow down, but the labor market is going to remain really strong. Wages are going to be up. So, whether or not we are in a technical recession, I think is not necessarily the most significant or the most interesting point. I think it's mostly about, how fast consumer spending is going to decline to bring down inflation, because there's a domestic source of inflation related to consumer spending. Okay, I want to just bring everything together. So at the end of the day, what matters is profit. So if you look at food and beverage manufacturing gross margins, and so I'm aggregating a bunch of different businesses that sometimes face different dynamics. And so bear with me, I'm going to show you a breakdown of a few different sectors in just a second. But overall, I think this particular chart shows a trend in gross margins for food manufacturers, right? I would argue that overall, and again, generalization for sure, but overall, it's been easier in 2021 to pass on some of the higher costs that food manufacturers were facing, right? We had commodity prices. If you think of crops, if you think of livestock, if you think of a number of different commodity prices, which are determined basically in the global market, they were quite elevated in 2021. The war in Ukraine did amplify some of those upward patterns in commodity prices and so forth. But it was easier in 2021 to pass on some of the higher costs that food manufacturers faced to retailers and to consumers. Whereas in 2022, it's been a lot more difficult. The retailers face their own cost pressures as well. And we built an index of margins to basically look and say to a business, well, overall, if your margins is X dollars, you could expect maybe a decline of around 10% in your margins from 2021 to 2022. That's a little bit of that, how the index would function here. Now, if you break it down to by sector, and maybe we can blow it up a little bit on the screen to have a better visual, but the story is a bit similar, but obviously different businesses because of processing different commodities, serving different markets and so forth, would face different dynamics, right? So breweries, for example, is an interesting case where, margins have been declining, as I was just saying, overall for the industry, but the decline has been a lot more significant, right? If you focus on the top chart, on the chart in the top northeast corner of the screen, you can see that the index comes down all the way down to 52.4 for the first 6 months of 2022. Bottom line is same kind of story as I was telling: commodities, labor costs, or interest expenses and so forth, but also the competition in the brewery industry is quite intense. And so that makes it a little harder to pass on some of the cost increases that breweries face, right? Whereas in a business like grain and oilseed milling, very, very strong demand for vegetable oil, for a lot of those different products that are coming out of this industry. And so it's been a little bit easier, given the strong export markets as well, to pass on some of the cost increases in that market. So what about 2023, right? Because at the end of the day, this is all about looking forward. So on the next slide, you have an overall index of food manufacturing sales. Well, it's not technically an index, but just sales measures in dollars. And what we have is that in 2023, we have growth of around 3.2%. So the story behind this is we expect that on a volume basis, sales will be flat, but there will be also inflation coming down. And export markets are not going to be as strong as we had in 2022. There is potentially an economic slowdown globally. And yes, the lower Canadian dollar is going to help, but overall, I do think that we expect softer export markets, which would softening sales and have a limited growth in 2023 after the significant growth that we had in 2022. If you are doing the same exercise with regards to sales and looking across different sectors, I think inflation is expected to come down, and that explains some of the lower numbers that we have. So again, I think it's not necessarily domestic volume that are weak. It's really inflation that's coming down, as well as a lot of question marks around export markets, right? So in some sectors that are more exposed to global markets, if you think of meat manufacturing, for example, we think inflationary pressures are not going to be as significant. If you look at a market that's almost entirely focused on the domestic market, if you look at an industry that's almost entirely focused on the domestic market, like for example, dairy manufacturing, then you would, you see that, sales are expected. It'll be easier to pass on some of the higher cost increases. So for 2023, expect some growth, domestically, I would say more so than the export markets, as well as some continued pressures on margins. So Darlene, I'm going to send it back to you after this brief overview of the report that you find on our website, and see if you have any questions that came in online, and perhaps as well we can check in later with the crowd here in Ajax if we have any questions live that we could take on.
Great. Well, thanks, JP, for that great overview and some of the projections that you're seeing for 2023. I'm hoping that everybody enjoyed your presentation. And I have a question for you, JP. You mentioned a few minutes ago commodity prices and the impact of the war in Ukraine, and how that has had commodity prices rise in the past little bit. And how do you see the commodity prices moving forward, and how this might impact the cost for some of the food manufacturers that are really reliant on those ingredients?
Yeah, so good question. So we had quite a bit of roller coaster in the last 6 months, right? So we started, if you go back to when the last time we published our report, we had commodity prices that were quite elevated then. We were just at the beginning of the war in Russia and the war in Ukraine, Russian invasion of Ukraine, and that lifted commodity prices all the way through the entire spectrum of commodities, really. I mean, if you look at energy, but also crops, livestock, and so forth. And those prices at some point in time did come back down. We had a little bit of relief when it comes to crops. We had prices that came down a little bit. We had even now with an agreement for safe passage of some of the commodities out of Ukraine. So that actually brought a little bit of relief in the world when it comes to food security issues. Now, if you focus on the last few weeks, we've seen prices actually revert back upward in that trend. When it comes to prices, and part of the reason is a lot of different challenges that we have with supply all over the world. If you look at Europe, it's been going through a major drought, and so a lot of the commodities have seen their prices go up. If you look even at parts of the U.S. that are faced with significant dry conditions for a lot of different crops, that has brought prices up. So the markets are quite nervous, right? So the war in Ukraine amplifies everything. But if you even abstracting from the war in Ukraine, if you look at the fundamentals for commodities, if you look at supply or expected supply for this next year, as well as what has been the overall trend in consumption, markets that there's quite limited supply for everything that is expected to be consumed going forward. And so that's what makes market really nervous. Yes, the war amplifies everything, but the fundamental story between supply and demand is one of which supply is quite limited with respect to demand. Now, what could happen to bring prices down? I think overall a major global economic slowdown would bring commodities down for sure. If you look at China, they're going through a lot of issues in the economy. That COVID zero policy is quite hurts the economy. Their real estate market is ailing, but overall, I think I'm fairly confident that we're going to see stable to some growth in demand for commodities. And with the supply being very limited, I do expect that we're going to live in an environment where commodities are going to remain elevated for the next 12 months, and expect quite a bit of volatility, as you mentioned in the introduction of the question. I expect quite a bit of volatility because of the war.
Okay, great. Thanks for that response, JP. So I have a question here from our virtual audience, and I do welcome any questions from in the room. So if you have any, JP, if you peek over and see any of your guests there in the room that have questions, then please just let me know.
See if anybody has their hand up, but let them think of a question and then just go with the next.
Great.
All right.
Perfect. Okay, that's great. So the question here is regarding warehousing and transportation, and as concerned, like, what are you seeing in that in the food and beverage sector? Any insights on what you're seeing in regards to transportation and warehousing?
Well, I mean, it's interesting because in the moments leading to this particular event, we had lots of informal conversations, and the issue of supply chain is really top of mind. We got lots of supply chain challenges going forward that are still not resolved and might take a little bit of time to resolve. And I would include that transportation issues as well in the supply chain. I was talking about job vacancy rates, for example, when it comes to food manufacturing. If if you look at the trucking industry, they're faced with some significant job vacancy rates as well that are even higher than the ones that we face in the food processing sector. So transportation is going to stay expensive, I would argue, for the foreseeable future. Yes, we might see, especially if there is a significant, doesn't have to be that significant, if there is a global economic slowdown, that we might see some transportation costs coming down, but the industry is still facing some significant challenges. Demand for warehousing is actually very, very strong, and I think I would argue that it's going to continue to be strong. If you look at the demand for food, it's still be going up, and I think some of the growth that we're looking at over the next 12 months is actually coming from the domestic market. So overall, I do think that demand is going to be very strong going forward, and we're probably have not seen the end of the supply chain challenges that we've seen in the last little while here.
Great, good. I have another question. Do you have any on your end, JP? Or
not that I'm seeing. We got a quiet crowd here, so.
That's okay. That's fine. I have one for you in relation to the Canadian dollar and how the Canadian dollar, we've seen that it's declined recently. And how do you see, what are the implications on the food industry if it does continue to decline, or even if it remains the same? What do you see? How did that directly impact the food and beverage industry?
So first thing to note is that the weakness in the Canadian dollar with respect to the US dollar is about the strength of the US dollar, right? Because if you look at our currency relative to the euro, relative to Chinese currency, relative to a number of different currencies, we actually gain value against these currencies. I would argue even that we're probably going to continue to gain some value against the euro. The Eurozone is faced with quite a few challenges over the winter, or will be facing quite a few challenges over the winter. And that actually could weaken the economy further and perhaps, weaken their currency as well. But when you look at this strength in the US dollar, I mean, it's the fear factor a little bit, in the sense that if there is a global economic slowdown, there's a flight to safety when it comes to the US dollar. It's also the fact that the US Federal Reserve is quite aggressive when it comes to fighting inflation, and it's quite determined to fight off inflation. And so with that approach and the commitment to keep rates and to keep increasing rates until inflation comes down, and other central banks not perhaps following up with the Federal Reserve as fast as the Federal Reserve has moved up its key interest rate. So all of that, I think, points to a weaker Canadian dollar against the US dollar. Energy prices as well coming down would be another factor that would depreciate the Canadian dollar relative to the US dollar. When I logged in this morning, we were at 73, just a bit above 73 cents on the exchange rate. And if I look at our forecast towards the all the way to December and Q1 of 2023, we're projecting just a little over 70 cents. So we probably think that we're going to held there in terms of the loonie versus the US dollar, but there is perhaps a little bit more weakness. I do think that for most businesses in the food sector, it'd be a good thing. But again, on the flip side of that, if we're faced with lots of labor challenges, we need to invest in automation, robotics, automating a bunch of different things in our plants. And a lot of the equipment sometimes that we bring in is from Europe or other countries, right? So to have a weak currency against the US dollar might be a good thing from an export side. If we need to import from the US, that might not be a good thing. Good thing is our currency actually will be strong against the euro. Another thing as well is that our weak currency is not necessarily good to fight off inflation, right? So when our currency comes down, inflation usually goes up, everything else being equal. So if our dollar depreciates further, that may make the fight against inflation a little bit harder for the Bank of Canada, and that may them to lift interest rates a little bit more than what I suggested early on in the presentation.
Great. It's like a vicious circle. So inflation is a step, I'm reading the question as is. Is inflation a step change and therefore be quite flat once to get, I'm not sure if I understand this question here. Let me try to read this again. Is inflation a step change and therefore be quite flat? Okay, is inflation, is it expected to be flat once we get year over year comparison mid-2023?
I sure hope no, because inflation been flat, depending on where the flatness starts, right? So if inflation's around 10% right now, we make it flat. That means that prices keep going up at a rate of 10% on a year-over-year basis, right? Which makes that prices are continuing to increase at a very, very rapid rate. So I hope that we bring inflation down and we bring it down to all the way to 2% and it remains flat at that level. And that would, I think, be consistent with the stability that we've been used to. Because right now, what I'm sensing in the food industry is there are a lot of different questions around whether or not it's a good time to invest. I mean, we know of the challenges. I think businesses, for the most part, know of the challenges, know of the opportunities, but the overall inflation trend, I think, brings a little bit of uncertainty that I'm hoping that we can just get rid of. And I do think that's, despite some of the costs that we may impose on the Canadian economy by fighting inflation and raising interest rates, I think that's a needed fight, and see what kind of the result that we get, when it comes to the overall economic cost of raising interest rates. But we need to raise interest rates to bring down inflation. And I'm hoping that, some of the flat inflation pattern that we're talking about the question just show up when we have inflation all the way down at 2%. But the bottom line is, I do expect prices to remain elevated. I mean, if you look from a commodity standpoint, labor standpoint, there are just too many signals that suggest that the cost structure of businesses in the food supply chain is going to remain elevated. And so I don't expect prices to come down.
Okay, great. Good. We have two more questions that just popped up here. What are your thoughts on gross margins in the meat manufacturing industry?
So just taking the perspective of the entire supply chain, right? So we've had, if you look at the livestock market, we got no incentives or little incentives, I should say, in the US. The US drives the North American market, right? So we can look at our own numbers and that matters from time to time, depending on the area you're in and your buying patterns and so forth. But when you look at the US market, there is very little incentive or very little signs that there is an expansion at the farm level, right? When it comes to livestock numbers, inventories are down, and again, very little signs of an expansion. Now, till last week, we had the markets down a little bit, and that was because I think the livestock report came not as bad as people expected it to be, but it still show that the livestock numbers are down. So in the US, which suggests that, livestock prices are going to remain elevated. If you look at the next stage in the supply chain, you're looking at costs of meat packers, manufacturers remaining elevated. So I do think that meat prices are going to remain on this upward pattern. And hence the reason why also I expect inflation to lag, or let me put it this way, the reprieve in food inflation to lag the overall reprieve in the overall inflation that I expect to occur later in 2022 and early in 2023. We're going to see overall inflation down. Food inflation is going to lag simply because of some of the numbers that, from a commodity standpoint, that are showing that supply is limited in terms of the overall relative to the expected demand.
Okay. So we have a question around labor, JP, here, and I'm going to read it as is. So are we certain that Canada's labor demand, both in ag and non-ag, will hold, given the high interest rates? There's a lot of literature that shows that higher rates generally increase unemployment. So what do you see?
Yeah, so no, very good question. I said this at the very beginning, right? I think it's a misleading. So I do agree with the question, or the premise of the question, which is that, hey, we are in an industry that's not immune to economic fluctuations, right? So too many times I've heard that we're in a recession-proof type of industry where people need to eat and then everything's going to be fine, which is hardly the case. At the aggregate level, when you look at overall food consumption, we're fortunate enough in Canada that we're very food secure. I mean, we have segments of the population that are food insecure for sure, but overall, I think we're pretty fortunate to be able to have access to safe food supply that's safe, high quality, and so forth. But at the end of the day, this economic slowdown will, for sure, I think, shift some of the consumption patterns, and we've already started to see some of that, right? So food inflation is already high. We've had consumers a bit shielded from the higher rates when it comes to, bringing in a lot of savings into their consumption patterns. But once that's depleted by the end of the year, then perhaps that's a different story, and we should see even more shifts in food demand. But overall, if you take a big picture type of analysis, abstract from the fact that, yes, we might see a little bit of a bump here in terms of the outlook and not being as positive if we do have a slowdown in food demand, that overall food demand is going to continue to grow. I mean, we got plenty of evidence that, worldwide food demand is going to continue to grow. There's this westernization of food preferences that matter. And I think domestically as well, I'm quite confident that food demand is going to grow. So from a long-term perspective, right over an horizon of 10 years, then I do think that demand for food is going to grow. Demand for labor is going to grow as well. I mean, the big wild card in all of this is the ability of food manufacturers or farmers to automate a lot of different processes that they have within their businesses, right? And so interest rates from that standpoint matter as well. But I'm fairly confident that food demand is going to grow.
Okay, good. So I don't see any other questions here from our audience, our virtual audience. So I have maybe one last go. If anybody else in the room or in the audience have any questions for JP, this is your time. It's been quite informative, JP. You've delivered a tremendous amount of information, and I think there's so much to learn from what you said today, and a lot of key takeaways for our customers and non-customers and that work in the food and beverage industry. So thank you so much, JP, for sharing this very valuable information with us today. And thank you for all of our guests that have joined us today, both in Ajax, Ontario, and across the country. You will all be receiving in a few days a link to the recording of today's presentation so that you can rewatch it and share it with others. And at the same time, you will also receive an email with the actual FCC Food and Beverage Mid-Year Report that JP spoke to today. So there'll be an evaluation form that you can take a few minutes to complete, and it will help us to develop and improve our events like this one today. So if you want to learn more, like JP mentioned earlier, about any of our upcoming events that we're working on here at FCC, or to access any more information on food and beverage content, you can visit our website at www.fcc.ca/knowledge. So with that, and on behalf of all of our staff here at FCC, we thank you all once again and wish you all a wonderful rest of the day.
Every day is a new beginning.